Vox Royalty is a mining-focused, high-growth royalty investment company that's listed on the TSX Venture and the OTC markets. As Eric touched on, we only went public about 2 years ago, but the company was founded about 8 years ago, and it was created by investors, for investors, particularly intended for an inflationary environment similar to what we find ourselves in today. And I'll get into it further in the presentation, which I hope is much more a conversation than death by PowerPoint. But as Eric touched on, one of the key things that makes Vox different is we're able to find and acquire royalties that our competitors are completely blind to. So, for example, mining royalties that are held by hearing aid technology companies, or other mining royalties that are held by telecommunications companies. This is part of the unique strategy we've built over the last 8 years. I will be making some forward-looking statements, so I'd refer listeners to our disclaimer in our corporate presentation on the Vox Royalty website. So today I'm going to talk about really three main items. The first is what makes Vox unique, and how is Vox built. The second point is just addressing a few investor misconceptions regarding the royalty industry. We've heard quite a bit of noise from various investors in the last 12 months, and so I think it's worthwhile touching on a few of these misconceptions. And then the third thing I'll close on is just around what is our strategy to continue creating value for investors, over coming quarters. Now, the right-hand side of this slide, this is where the rubber hits the road for our management team. Ultimately, we're in the business of creating value for our shareholders. And since we were founded, we've invested $32 million, and we've turned that into over $140 million of equity value. So that really is, I guess, the North Star for us, is continuing to create substantial multiples on invested capital for our investors. A little bit about Vox as a company. As I touched on, it was created 8 years ago, but only went public 2 years ago. So still very much a ground floor opportunity. Eric mentioned we've developed the world's largest proprietary royalty database. So this is over 8,000 unique royalties are in this database, and it allows us to find royalties that our competitors are blind to, and bring them into our portfolio at fantastic value. As Eric also touched on, last year was a record year for Vox. We delivered exceptional exponential revenue growth, in excess of 350% quarter on quarter, and analysts have us exceeding that revenue growth over the coming quarters as well. So investors in Vox are getting on board Vox at a really exciting point when our revenues are really starting to increase, and that's without any additional capital requirement. Because as we stand today, we've got 5 producing royalty properties, and that's expected to organically grow to 10 over the coming 18 to 24 months. From a geopolitical risk perspective, our portfolio has been constructed with a very low risk. So over 80% of our assets are located in Australia, Canada, and the United States. And then lastly, our management team is heavily technical in nature. We're a group of mining engineers and geologists, obsessively focused on risk and reward, not just sort of investment bankers putting numbers in a fancy spreadsheet, hoping that we're going to get return on investment. A little bit about our capital structure. We have a very, very tight capital structure. We've got less than 40 million shares out. Our market capitalization is about 143 million, and we've got working capital of about $9 million on the balance sheet with no debt. Management owns about 15% of the company, so we're truly aligned with our shareholders, and our families own shares on top of that. And then importantly, the original cornerstone investors that seeded the company back in 2013, 2014 are still meaningful shareholders on the register. They haven't sold out because they're completely aligned with the strategy that we're executing on. So what really does make us different? People often say to us, "Oh, another royalty company. You seem to be growing on trees," which is a fair sentiment. There are about 30 listed royalty companies that are collectively worth about $70 billion today. So when we hear that comment, we empathize with it. But I think the important thing for us is we were created 8 years ago. So we saw the royalty industry getting more competitive. And so we built fundamental aspects to the business that would make us, unique and competitive for years to come. So as I touched on before, building the world's largest royalty database gives us, exceptional pricing advantage when we source really interesting royalties that, are uncompetitive deals generally. So they're not auctions run by investment bankers. They're deals where we're negotiating in good faith with a single seller. Our technical management team ensures that we don't allocate capital to the wrong mining projects. There's been a lot of royalties that have been written off to zero in the industry's history. And so having mining engineers and geologists who are allocating capital ensures that we don't, choose the wrong projects. And then lastly, there has been this fixation of some royalty companies as being obsessively focused just on revenue at all costs. That's not the way that Vox has been created. We're focused on accretive deals in terms of growing our net asset value per share, growing cash flow per share, and then ultimately return on invested capital per share. So while we are delivering exceptional revenue growth, that's coming at a very high return on invested capital. So we're not just blindly going out to acquire revenue at any price. We're acquiring it only where we can see that we can continue delivering sector-leading return on invested capital. A little bit about our royalty portfolio. We have 54 royalties located around the globe. They're heavily skewed in two key areas. One is towards Australia. So we're actually the second largest holder of mining royalties in Australia, second only to Franco-Nevada. And that's because we just see Australia as being one of the safest operating jurisdictions. And then from a geological perspective, Western Australia particularly, we see it as one of the premier, if not the best place to discover, develop, and operate a gold mine on the planet. From a stage of development perspective, we have 5 producing royalties currently. That's set to organically grow to 10 within the coming 18 to 24 months based on operator guidance. And then we have an additional 15 royalties that are in varying stages of development, all the way from construction, all the way through to advanced engineering studies that we believe have a very strong potential of coming into production in the medium term. The other key weighting in our portfolio is towards precious metals. We're 70% weighted towards precious metals, which is largely weighted towards gold. And then the other 30%, we're split right across the commodity complex with a heavy bias towards base metals and battery metals. Now I'll move into the second theme that I wanted to talk about today is, I guess, two investor misconceptions. The first one is around something we've been hearing from investors in the last 3 to 6 months is, some of the miners look so cheap. Why don't I just buy the miner rather than buying the royalty or the royalty company? We've been hearing this, particularly in the last 3 months, quite a bit. So this slide is really just, a worked example or a case study looking at the difference between buying a royalty or buying the underlying miner that operates that mine. So back in 2011, Franco-Nevada bought a royalty over the Edikan mine in Ghana for $35 million. And so what this slide's looked at is, two alternatives. Instead of buying that royalty for $35 million, if Franco-Nevada had bought $35 million of equity in the actual operator, Perseus, how would those two side-by-side investments have performed? And really, this slide really just goes to the fact of the lack of dilution that you get from buying a royalty and the leverage you get to production expansion and exploration upside. So Franco-Nevada, over that 10-year period, that royalty has generated in excess of $40 million of royalty revenue, and the mine still has a further 6 years of reserve life. So they've already received payback on that investment. Compared to the equity holder, had someone bought $35 million of equity in the operator, there would have been almost no dividends, unfortunately, they received over that 10-year period, and their equity interest would have been diluted from 3.2% of the company down to 1.1% as the companies issued further equity. So I'm not saying necessarily that this example holds for all listed mining companies, but I guess this just shows in real world numbers some of the incremental leverage and torque that you can get from buying a royalty versus buying equity in the underlying miner. The second sort of example, I guess, goes to investor misconceptions around what truly creates value in royalties, and conversely, what destroys value in royalties. And I'll start with the chart first, and then I'll touch on the text afterwards. The chart on the bottom really shows price to book ratio across our industry, and I guess what that means is market value relative to every dollar of capital that's gone out the door to invest in new royalties. And obviously those on the right-hand side, such as ourselves and Franco-Nevada, the market has rewarded us with a 4 times multiple on every dollar that we've invested. So essentially saying that we're buying royalties that re-rate in value, or we're acquiring them at really attractive prices. And then conversely, towards the left-hand side of the chart, there's a few of the newer entrants to the royalty industry where dollar for dollar that's going out the door, the market basically has said, yes, you're paying effectively what the royalty is worth. And you naturally see from the shading in this chart that, generally speaking, royalty companies that have been in the industry for a longer period of time, or through the darker shading, generally speaking, have been allocating capital to royalties that have appreciated in value, and then the market has given them that premium. So, at Vox, as I mentioned earlier, our North Star is really return on invested capital. So this chart really, I guess, summarizes, how we've been able to deliver value on every dollar invested. And then just finally, I guess what really creates and destroys value, it really comes down to technical due diligence, understanding the risks and rewards inherent in any mining asset, and then allocating capital to the right projects. It sounds pretty obvious, but within our industry, there's been a lot of examples of management teams that aren't technical in nature, that have fallen in love with the wrong mining projects, and then subsequently had to impair those assets. On the positive side, a lot of the outperformance has been linked to picking royalty assets that are right on the cusp of a major event, just about to move into production or just about to be expanded. And I'll touch on that in the next slide. So part of how Vox creates value is a strategy that we call event-driven acquisitions. So we're consistently buying royalties that are right on the cusp of a major event. So these are 4 gold royalties that we've acquired in the last 2 years, that within the space of 18 months, these royalty assets have fundamentally transformed in value. They've had multiple resource upgrades, major mining studies have come out, and then in a few of the cases, major expansions have been commissioned by the mining companies. So, that's what's allowed us to turn every $1 invested into over $4 of market value, this event-driven acquisition model. In terms of looking forward of future catalysts on the horizon for Vox, as I touched on before, we're in this really high growth phase where we've gone from 1 producing royalty asset to 5. That's set to increase to 7 organically by late this year. And then, in the near term, we see that increasing to 12. So that's new royalties that are in construction or about to move into construction, that will ultimately start generating revenue for our investors. And so analysts have our revenue continuing to grow at a really exponential rate over coming quarters. So a really exciting time for investors to have a look at Vox. And then just lastly, I guess, why Vox and why now? I touched on the exponential revenue growth that we've already delivered and that's still to come. And that's largely driven by an organic increase of, from 5 producing royalty properties to 10. I touched on also how our disciplined approach to royalty acquisitions. So really targeting, industry-leading return on invested capital. So investors can be confident that we're going to be very disciplined with allocating their capital. And then lastly, we've been really fortunate to have a number of new research analysts initiate coverage on Vox in recent months and quarters. So, we've seen that help liquidity, and we're also looking at potential options around secondary listings. So with that, I'll wrap up, and thanks so much for your time.